Ladies and gentlemen, good day and welcome to Q2 FY23 earnings conference call of Ramkrishna Forgings Limited, hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prateek Vajani from ICICI Securities. Thank you, and over to you.
Thank you, Sashri. Good afternoon, everyone. Welcome to the Q2 FY23 result conference call for Ramkrishna Forgings Limited. From the management, we have Mr. Naresh Jalan, Managing Director, Mr. Chaitanya Jalan, Whole-Time Director, Mr. Lalit Khetan, Executive Director and CFO, and Mr. Rajesh Mundra, Company Secretary and VP Finance. Now I would like to invite Mr. Lalit Khetan for his opening remarks. Over to you, sir.
Good evening and a very warm welcome to everyone present on the call, and wish you all a very happy Deepavali and New Year from the entire Ramkrishna Forgings team. We hope and pray for the safety, health and security of you and your loved ones. Along with me, I have Mr. Naresh Jalan, our Managing Director, Mr. Chaitanya Jalan, Whole-Time Director, and Mr. Rajesh Mundra, our Company Secretary. Hope you all have received our investor presentation by now. For those who have not, you can view them on the stock exchanges and the company website. I will briefly speak about the business landscape and update on performance in the preceding quarter, following which we will be happy to respond to your queries. Before delving into the company's performance this quarter, I would like to provide some context in the industry. The Indian auto and auto ancillary have faced numerous headwinds in the last 2-3 years, from managing emission and safety-related regulatory changes followed by COVID-19 to semiconductor supply shortages and the most recent steep commodity inflation. The auto industry has seen it all. During the COVID period, the China Plus One theme gained traction, with several OEMs around the world considering and acting on diversifying component sourcing away from China, which began with the United States imposing tariffs and trade barriers for China, with Indian OEMs and auto ancillaries benefiting from this progress. Because of India's low manufacturing costs, scale of vehicle production and maturity of its auto ancillary industry, companies like us are gaining from it, as we have the capacity to meet such demand. Furthermore, the ongoing festive season as well as adequate rainfall across the majority of the country will shape the industry in the coming months. Infrastructure and real estate are expected to boost this industry, as is e-commerce as well as transportation and logistics, which are critical to the economy. As a result, there is a lot of optimism about the growth, and the OEMs are very bullish. Our conversations with customers have been encouraging, which gives us hope for the future. Our international business has witnessed a sustained traction over the last few quarters, with new business order flowing in at a steady pace. A strong order backlog from Europe and United States and a healthy recovery for new truck orders in recent months bodes well for us. And we expect our export revenue to grow by more than 15% in FY23 as compared to last fiscal year. I would now like to highlight some business enhancement. As we are all aware of our long-awaited acquisition of ACIL, we expect it to be completed this fiscal year if we receive favorable results in next 1-2 months from Supreme Court. Our business to the electric vehicles has shown good traction, and we will form 3-4% of total revenue in near future. Our railway business has also shown a good development, and we are confident that it will contribute more than 4% of our total revenue, which is at present is 2% only. Coming to our business operation front, our revenue is increased by 32% in Q2 FY23 over Q2 FY22 on the back of robust and diverse business. Our EBITDA margins for the quarter were 22.3% and for H1 were 22.2%. During the quarter, we increased our capacity utilization by 300 basis points to 82% in Q2 FY23 from 79% in Q2 FY22. While the sequential improvement was 400 basis points. Such revenue growth and stable margins have been aided by improved product mix and easing supply chain constraints despite high commodity prices. We are confident that by improving capacity utilization, we will be able to deliver similar results in the second half of the year, resulting in higher operating leverage and margin expansions. We have received 5 orders amounting to rupees 408.5 crore in the first 6 months of FY23, and we are confident that we will receive additional orders in the second half of the year due to strong pipeline and positive business visibility. We are making concerted efforts to diversify our product portfolio and geography by introducing value-added products across the board. During the quarter, we received approval for a fundraise via preferential allotment of convertible warrant of rupees 94 crores, and the majority of which will be used for reduction of debt. We are adhering to our capital allocation policy in order to reduce debt, and our gross debt position as on 30th September 22 is rupees 1,319 crore, down from 1,577 crore as on 31st March 2022. Our target to become net debt-free company by FY22 remains intact. And also, as per the policy on the dividend front, the Board of Directors has declared second interim dividend of rupees 50 per equity share, rupees 0.50 per equity share of face value of rupees 2 each. That is from my side. We can now open the floor for question and answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of T.S. Vijay Sarthi from Anand Rathi. Please go ahead.
Good evening, sir. Thanks for this opportunity. So we've seen very strong sequential growth in the revenue to the extent of 17%, comparing Q1 FY23 versus Q2. Now, out of this, 11% has been by realization. So we had strong growth. Why did we experience 300 bips margin, gross margin fall between the same quarters? Could you please help us understand? That's my first question. And I mean, the realizations of export realizations would have also been very good. So given this, why margins have fallen sequentially, gross margins?
You are talking about the year-on-year margins, correct?
I'm talking of sequential margins, sir. Q1 FY23 versus Q2 FY23.
The Q1 FY23, if you're looking at consolidated number, it has gone down a little bit, but if you look at the standalone, it has gone up.
Yes, I'm referring to the consolidated number.
Yes, so consolidated number is little bit because there has been on the subsidiary front, there has been little bit traction on the profitability on account of performance, and that's also marginal. If you look at the full year, half year number is 22.2%, and for the quarter is 22.3%. For the standalone, and console number is around in the range of 21.5%. And for the last year, there were no number for the console. It's only because very less performance, and whatever with the standalone performance, that was the console performance, and that was in the 24% range kind of thing. And that was also on account of higher exports, because if you remember, Q1 FY22, that was due to the second wave of COVID, and there was very less domestic sales, and export percentage was around 60%, and that has resulted in the higher margin.
So what is the steady state margins that we are looking at, sir? Whatever you spoke about EBITDA margins, so you could highlight that.
Certainly, the current margin levels are here to sustain. We are going to sustain the current margin, and endeavor will be to improve upon these margins.
Sure. And the other small question is, again, between sequentially, Q1 FY23 to Q2 FY23, the power and fuel costs have come down from 45.8 to 43.3. While the activity has gone up, production activity has gone up, what led to this fall in power? Because I am given to understand that the per rate is per unit is fixed. So the activity has gone up, why power cost has come down? What is that we have done, and is it sustainable? This is the second question.
So, MD sir, are you taking that?
This is basically on account of better utilization. If you see sequentially, there has been a significant improvement in utilization, and power and fuel costs are directly affected with the better utilization. As you have yourself said, the power cost is fixed. So if in number of hours we utilize the equipment, the better utilization gives us a better yield on in terms of efficiency in the cost.
You are referring to the per unit cost, I mean per ton cost rather, right?
Not per ton cost. It's
absolute cost also.
Absolute cost of power.
Yeah.
Vis-a-vis the number of tonnage we produce.
Okay. Does it have a bearing on the kind of press lines that you operate, sir, or is it to do with only merely higher utilization?
It is the way our test lines are placed and as well as the utilization. Both may take part into it.
Okay. Finally, you had mentioned some order book in the initial remarks for the first half. We missed that, or you did not mention, I don't know. So could you just help us? You said 5 orders, new orders.
Yeah, 5 orders, totaling 408 crore in the first 6 months.
Okay. Great. Thanks a lot. I'll come back.
Thank you. We have our next question from the line of Mumuksh Mandlesha from MK Global. Please go ahead.
Sir, thanks for the opportunity and wishing team happy Diwali and New Year. Sir, what led to the 19% volume growth sequentially for the exports market? And if you look at the North America CV basic bodily were flattish sequentially. So what led to the strong growth, sir, volume growth for exports?
No, basically it's because of past order wins. Now orders are getting converted into revenue, and we have been able to convert them faster. And all those conversions have helped us in getting the growth in exports.
Sir, you, in the commentary you mentioned China plus one beneficiary, Ramkrishna being beneficiary of that move happening. Sir, can you talk about the opportunity there? And you mentioned some import duty on Chinese imports from USA market. Just can you share a bit on that?
I think in terms of import duties, we are not aware of any import duties. I don't think Lalit's opening statement has anything to do with import duties. China plus basically because of the supply chain and COVID restrictions, lot of supplies, customers are shifting their supply chain from China to other places, and one of the biggest beneficiary of that is the Indian industry. And it is not alone RKFL, it is across the board pan-India and across all segments. Indian manufacturing sector is getting legs up due to this shifting.
Right, sir. Thank you, sir. Just on any update on ACL, can you just share what kind of opportunities you see for that business?
I think it is very, until we get the company, it is very difficult to say about the opportunities. Once we get the company, we will appraise the investors on the opportunities. But as a management, when we have bidded for the company, we are very confident of getting new customers, new sectors, and maintaining a good top line and bottom line from the assets over there.
Thank you so much for the opportunity.
Thank you. We have our next question from the line of Varun Basrur from Julius Baer Wealth Advisors. Please go ahead.
Yeah, good afternoon, sir. I hope I'm audible.
Yes, you're audible.
Yeah, hello. Yeah. So, sir, I have 2 questions. First question is, if I look at the other expenses on a quarter-on-quarter basis between quarter 1 23 and quarter 2 23, there's been a jump. Any commentary there? Are there any one-off items in this other expenses? So, second question is, sorry, sir, you want to answer?
Okay, please carry on.
Right. And, while there was very positive commentary which you gave, especially on the export order book and new businesses flowing in, just want to understand in Europe, have there been any deferments on the existing new programs or on the existing order book? I'm done with my questions.
Yeah, so let me address your question on other expenses. Basically, other expenses jump is due to the increase in export expenses because the export ocean freight, which that was in the Q1 last year. And now you're looking at certainly there, that's why the gap, though it is coming down, but last year it was quite steep and it has increased over the quarters, and that level we have not gone back to those levels right now. That's why there is a gap, and slowly it will go down. And on the, I think Europe and this order, Naresh will come to, will
I
answer.
think we are not seeing any cancellations or deferment from our European OEMs.
Okay. Can I ask one more question?
Hello.
Yes, I just want to ask one more question. I'm just going through the capex guidance, and there's some press lines which are being added. Just what is the incremental capex in tonnage that has been added in the press line, or that will be added in the press lines?
I think 56,000 tons roughly. We don't have the exact calculations.
Yes, sir. 56,000 tons will be added.
Yes.
Over and above 117,000 tons.
187,000 tons.
Total capacity 187 plus 56.
Okay, and this is all added in press, which is 117,000 tons today.
Yes. It will be added in the press. There is an upsetter, the rest is a press line.
All right. Okay, thank you so much.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Sunny Gosar from MK Ventures. Please go ahead.
Yeah, thanks for taking my question and congratulations on a strong set of numbers. My first question is relating to the freight cost. So you mentioned in one of the previous responses that freight costs have started coming down. And when we basically, if you can help us understand what's the freight cost as a percentage of the revenue and how much benefit can come in the coming quarters due to the decline in the freight cost?
Sunny, the freight cost as a percentage of revenue, you can look at it should be in the range of around 15 to 16% right now in terms of export revenue, okay? Because it should be linked to export revenue. And so it was, if you look at the earlier, it was more than 20%, and now it has come down to the 15 to 16% level, and it is certainly it is poised to go down further.
Any ballpark number in terms of how much further it can go down?
No, it's very difficult to predict. Really difficult to predict.
Sure. My second question is on the debt number. So as of March 20 number, which was about say 1,570 or 15, there was some factoring component of about 150 crores. So in the current gross debt number of September 22, is there any similar factoring number or?
Yeah, it is there, the factoring number. So net debt has gone down by 110 crore in H1 FY23. So the net debt as on 31st March 22 was 1,336 crore, and currently it is at 1,225 crore.
Okay, so your reported gross debt of about, I think, 1,380 crores has about, reported gross debt is about 1,320 crores, I think. So there is about 90 crores of factoring.
Yeah, correct. That's the Tata Motor bill discount, basically.
Perfect. And my third question is, basically, if we look at RK Forging, historically, it has always been classified as an MHCV ancillary. So if you can help us understand with the new orders in EV and LCV and passenger vehicles, so out of the 80% automotive revenue, what would be broadly the mix between, say, your MHCV, which includes India and North America Class 8, and your other automotive, which will include LCV, passenger vehicles, Class 5 trucks in maybe North America?
Sunny, I think in terms of MHCV, we are no more an MHCV supplier. MHCV as a basket is only 50% of our automotive volume. Balance 50% of my automotive volume comes from Class 8, LCV, every vehicle which is below 9 tonners, basically.
Right.
It includes all varieties.
Right. And going forward, will this mix further improve away from MHCV, or this business mix will broadly remain like this?
No, we have, like for North America, we have entered the off-highway segment also, tractor-trailer segment. These are going to add on into in terms of new varieties which are going to come in near future.
Right. So basically, MHCV dependence will go down further.
Yes.
Sure. Thanks. I will come back in the queue.
Thank you. We have our next question from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Thanks for the opportunity and congrats for a strong set of numbers, sir. Sir, currently rising energy cost in Europe is a big challenge. are any shift of business from Europe to India, and will it benefit to the Indian forging company for export in the US and Europe?
I think I cannot comment on the other forging companies. In terms of RKFL is concerned, like I said in my earlier questions, we are not witnessing any cancellations or deferment in terms of our new order wins and order book. We are experiencing new order intake in a steady manner, and I think one of the major contributors to it is the energy prices which prevail right now in Europe and US both.
So you want to say that you are getting benefit of increasing energy cost in Europe, that's why the business is coming to the Indian companies?
That is one of the factors.
Okay, fine. And sir, during this quarter, we have seen a sharp jump in the realization of front, around 11% quarter-on-quarter growth, despite the sharp fall in the steel prices, around 25 to 30%. So what is the reason for the increase in the realization, and how do you see impact of the realization because of the fall in the steel cost in the coming quarter?
In terms of realization, I think it is purely, there is a part play of raw material pricing as well as part play mainly due to change in product mix and new order geographies and new order book coming into play in terms of getting into revenue. In terms of future, steel prices right now are extremely volatile and extremely difficult to comment how this is going to shape up in future. But if steel price decreases from here, the similar will, in similar quantum, the realization also may change.
So why there is no impact on your realization front despite the fall in the steel prices? And if I say that the product mix as well, there is not a significant improvement on the price line utilization. So in that case,
overall, I think you, in terms of utilization, never speaks of the product mix. Utilization speaks of the tonnage being used. Product mix is purely what, as a company, we know what product mix we are changing.
Okay. So you want to say that the products like the heavy products like Excel and all, they have gone up?
No, I would not like to comment on that. Basically, company has done better product mix. That's the reason realizations have gone up, and partly due to raw material prices, this has been there. Raw material price decrease has...
There was no decrease in raw material prices for us during the quarter.
Yes.
Because see, the first H1, there is no decrease in raw material price, what we have witnessed last year in the steel we are using.
Okay. And sir, as you mentioned that you are going to acquire the ACIL in the coming months, so just wanted what is the cost of the ACIL acquisitions and how much incremental revenue will be from that?
In terms of, I think we have already appraised the investors, I think, regularly basis. It's around 110 crores which we will need to spend to acquire the assets. And in terms of revenue, right now it is extremely difficult to say in the current environment what is going to be the revenue. It is after we get the acquisition completed, we obviously will inform all our investor community on exactly the status and what is the revenue expected out of that.
And it is a machining capacity only, no?
Yes, it's a machining capacity.
And two-wheelers and tractors?
Two-wheeler tractors.
Okay. And so what is your capex guidance? You have already done around 1.7 billion the first half. You are going to acquire the ACIL and it will get around 1.1 billion. So for FY23, what is your capex guidance?
See, for FY23, we have not considered ACIL so far. Let ACIL comes, then we will decide on that, and that will be in the SPV. And for RKFL standalone, we are looking to spend another 100 crore in FY23, whatever we have spent so far, apart from that.
And you are just adding the capacity of around 56,000. So most probably all capex would be completed in this year?
No, it will spill over to the next financial year also. Okay.
Okay.
That capex will be not completed in this financial year.
So for this 56,000, what capex is required?
I don't have the exact number. I think another 150-60 crore will give us this 56,000 ton capacity. Whatever we have already spent the money on this capex, and another 150-60 crore will give us this capacity, another 56,000 crore.
Okay, sir. And my last question on this, what is the outlook for the North America Classic trucks for the next 2 quarters?
We will not be able to answer specifically to what is going to be the outlook, as we can only say that whatever we hear right now from our customers across North American geography, across all our portfolios, we maintain the same statement that we are running a healthy order book, and we sustain to continuously grow on the geographies.
Okay, sir. Thank you. Thank you. That's all from my side.
Thank you. Reminder to participants to press star and 1 to ask a question. We have our next question from the line of Mitul Shah from Reliance Securities. Please go ahead.
Thank you, sir, for giving opportunity and wishing Happy Diwali and Happy New Year to everyone. Sir, first question again on average selling price only, that realization has improved. Sir, can you elaborate something on this product mix change, maybe just by 1 or 2 example? Does it mean increasing more machining within a product, or a complete change of design, or maybe tonnage wise? How you will define better product mix?
Is mostly changed from, some products have changed from machining to assemblies, and some product from forging to machining. And some we have, because of current order book, we have been able to utilize better the press, getting more higher tonnage into the same presses. All 3 have been factors contributing to higher realization.
The kind of sub-assembly type of module we started.
Sub-assembly and assemblies both.
Okay. Okay. Second question, sir. This quarter geography-wise mix, how was this North America, Europe? We have given half-yearly in presentation. Can you just briefly quarterly for the quarter?
This is almost similar to that. We have not given present, but it's almost near to what we have done in the half year, same in that quarter also.
Okay. No major change.
No major change.
And sir, outlook on Europe side?
I think outlook is steady, and we'll keep on growing.
And so one thing is that, as you highlighted, that because of the better supply, particularly in the export geographies, our production volume as well as production level of MHCVs in those areas have increased. So it must be to some extent backlog of past few months where the semiconductor and other component supply were the issue. So probably even next 1 quarter we can see similar bump up type of thing, but after that it may normalize. So what is your judgment that after 1 or 2 quarter, or it may be from next quarter onwards it should normalize?
I don't think there is anything in terms of normalizing or pent-up demand. We are seeing a steady demand, and with new order wins, I think our basket is filled up to the extent we require in terms of keeping on with our predicted growth of 20% CAGR.
And lastly, on this realization, you highlighted that it is all product mix. There is no change in the raw material side, right, sir?
Raw material.
There is no decrease. There is no decrease in raw material.
No decrease, yeah. That is no change. So going forward, probably it would be a slightly correction, as in we earlier highlighted. Also, it is a pass-through type of thing.
Yes.
So it would be reflected in Q3, or still there would be some lag effect and may come entirely in Q4.
See, it is every quarter raw material price increases or decreases. So if the trend continues or decrease, every quarter you will see decrease, and if it stops after 1 quarter, you will not see after 1 quarter.
Okay, sir. Thanks, sir. Thank you very much, and all the best.
Thank you. We have our next question from the line of Shashank Kanodia from ICICI Securities. Please go ahead.
Yeah, good evening, sir, and thanks for the opportunity. So I just wanted to understand on the capex part. So we are operating at roughly 65% utilizations as of first half, right? So what's the pressing need for us to do a good amount of capex at this point of time? And will it be adhering to a broader capital allocation strategy wherein we intend to spend roughly 30 to 40% of our cash profit for capex?
I think first of all we are not augmenting the same capacity which we already have. We are creating new capacities in new generation press lines with new technology, and specifically going into cold and warm forging. And in terms of overall, if you see, our capacity utilization is close to 82%. So we will need to augment and these are all time-taking capacity additions. These do not happen overnight. It takes its own time to first plan, put and stabilize the capacity. So company as a whole is planning way ahead of time so that when capacities are required, we have those.
Okay. And so we have outlined a capital allocation strategy a couple of quarters back. So will this capex adhering to that allocation strategy, or is it diverting from that front?
No, it is. We have already committed to it, and in our presentation also you can see any capex which will happen from free cash flow generated by the company during the year, and we will surely adhere to those plans of debt reduction and allocating balance capital for dividend and capex.
Okay. So sir, so what kind of debt reduction we can expect for this year, FY23?
I think we have already had a net debt reduction of close to 120 crores, and company wishes to repay another 100 crores of debt by year end.
Okay, and the target for being net debt free is by which fiscal year for us?
2025.
2025. Fine, sir. Thank you so much, and wish you all the best.
Thank you. We have our next question from the line of CA Garvit Goyal from Invest Research. Please go ahead.
Hello, am I audible, sir? Hello, am I
Can
audible,
you speak
sir?
louder, please?
Hello. Am I audible?
Yes, you are
Go
audible.
ahead.
Okay. Yes, sir. So my question is from the cash flow working capital management side. I was basically going through your historical numbers, and I found that in last 3 years, that is 2020, 21, and 22, there has been a significant increase in the percentage of inventory to your total revenues. So can you please explain the reasons and how inventory management or basically the working capital management going to shape up in the next 1 to 2 years, sir?
In the last 3 years, if you see, the prices of steel and other goods have also considerably gone up. So if you are only seeing on the valuation part, yes, there has been an increase. In terms of tonnage, there has been a decrease. And if you see the sequential growth of the company year on year, there is substantial growth. And I don't think inventory is, if you really calculate, inventory has gone up as much as the growth. And going forward also, company emphasizes or feels to preserve cash rather than inventory. So we are already working on inventory reduction, and this is going to happen over next quarters.
Okay, understood, sir. And so basically that 56,000 new capacity addition, you mentioned in the presentation that your capex for half year 23 is already 153 CR. So this 153 CR is entirely on that capacity, or it is for any other?
Entirely on that capacity.
And this 100 CR you are mentioning in between the second half, so that will also be for that capacity.
Yes.
Okay, understood. And in next year also you are mentioning 150 CR.
So I think Lalit has said overall we feel that another 150 crores of capex will be required to complete this 56,000 tons of capex. Out of this, 153 crores have already been spent, and another 150 crores will be required.
Okay. Understood. Sir. And what is your guidance for the top line by the end of financial year 25?
No, I think we have said that we look, and a company earnest desire is to continue with the growth path which we are in, and we look at 20% CAGR growth continuously.
Okay, and EBITDA margins, any guidance, or it will sustain 22%?
We will be able to sustain these margins, and company looks to improve its internal parameters and improve on the margins.
Understood, sir. Thank you very much, sir. That's from my side.
Thank you. We have our next question from the line of Darshil Pandya from Finterest Capital. Please go ahead.
Hello, sir. Actually, both of the questions are answered by Shashank and Garvit. I had the same questions for capex and inventory level. Both of them are answered. Thank you so much. No more questions.
Thank you. We have our next question from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Thanks for the opportunity again. Sir, you are talking about a 20% CAGR growth for the next 2 years. For FY23, what is your volume growth target?
See, Abhishek, we have already sold around 62,000 ton in the first half, and we are looking at around 68,000, so 130,000 shall be our sales target for FY23.
And what would be the mix export versus domestic, likely?
That's right, range of 40 to 42% on the side of exports, the rest is domestic.
Okay, sir, thanks. And sir, in this quarter, in last 2 quarter, production was slightly higher than the sales. And as the transit time is now going down for the export, so are you looking for some de-stocking in the coming days?
Would not got you, Abhishek. Can you repeat?
Sir, as the production in the last 2 quarters, that was slightly higher than the sales. And the transit time is also going down for the export, as you mentioned. So are you looking for some de-stocking in your export market?
No. See, it's the function of demand from the customer and what if the consumption is happening. So it depends upon entirely the demand, supply demand scenario. And we are not looking at we are feeling that demand will be more and the export will improve from here quarter on quarter.
So generally, how much inventory do you maintain for the export market? For how many days?
No, we don't maintain the inventory. We have a inventory in Europe little bit, and that's in the range of 50 to 60 crore, and little bit in the US, that is 30 to 40 crore. So that's the inventory we are maintaining in overseas market.
Okay. And sir, how much the foreign debt in the balance sheet and how much forex losses this quarter?
We have gained about 12 crore of net foreign exchange on this quarter. That is considering the loss on account of debt on the restatement of debt on the forex. But we have the debt also in the euro where we are gaining also. So it's a mix of the entire thing. Net gain is 12 crore for the quarter considering all foreign exchange assets.
Okay, sir. And sir, what was the LCV contributions in this quarter in the first half of FY23 in total revenue?
No, we don't have a breakup of that roughly, but LCV should be close to 6 to 6.5%.
Sir, my last question is related with this non-auto segment. What is your plan to ramp up your business? Already contribution has increased around 19%. So what is your target?
We are going to continuously grow. I think we are looking at making basically non-auto segment at 25%. So I think our endeavor is to continuously improve on that till we achieve a 25% level in terms of our non-auto business.
So what is your current order book in the railway segment, and what is your revenue target for 2023 in the revenue?
Railway order book is approximately around 100 crores plus, and we are looking at doubling the railway orders in the order book in this year. And I think we are looking at close to 200-250 crores in FY24 in terms of our railway sales.
Okay. Thank you, sir. That's all from my side.
Thank you. We have our next question from the line of Mitul Shah from Reliance Securities. Please go ahead.
Sir, thank you for giving opportunity again. Sir, 2-3 clarification. This 56,000 tons new capacity coming, and you said it will be fully operational by next year. So I believe that it will be operational in a phased manner. So what could be the likely capacity by end of current financial year, initial first phase?
I think 50% of the capacities will be ready by March 2023 and balance 50% by September 2023.
And as you highlighted, it's a specific purpose type of a capacity. So based on existing order, can you just give broader
No,
indication?
I think it is very early. I think obviously we will wait for another quarter before we give guidance on that. We would like the capacity shape up before we start giving guidance on that.
But we must be having a few orders related to that capacity
We
right
already
now.
have development orders in hand, but in terms of if you want exactly what is going to be the volume and revenue and profitability, it is very early for us to comment on that.
Okay. So secondly, on the MHCV side, in earlier remark, you highlighted that MHCV contribution has now come down to 50% of automobile segment. So that is 80%, 50% means you would want to say that only 40% of the revenue is MHCV right now?
Yes.
And does this include Class 8 truck or it is only domestic MHCV you are talking?
I am talking about entire MHCV.
Okay, so 60% is all non-MHCV, LCV, PV, non-auto, everything.
We are not into PV in any way. We are into LCV, any vehicle from 9 ton to below. I am talking about.
Got it, sir. Thanks. Thanks a lot.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. We have our next question from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Sir, I've got two questions on my side. One is, what is our total order book as on September end? And second is, how much are we spending on 4 megawatts of solar, the plant here, power, so solar power actually?
In terms of order book, it is very difficult to, because we work with OEMs who work on 3-month schedule or a month schedule. So order book, it is very difficult to define what is the order book right now. And in terms of 4 megawatt power solar power plant, we are looking at spending somewhere around 12 to 12.5 crore rupees right now to install this 4 megawatt power plant.
Okay, this is including the 100, this 12.5 crores is part of the 100 crores you intend to spend, or this is over and above that?
Part and parcel of the overall capex spending plan of the company.
Okay, okay. And what was the first 6 months order we have received total?
I think first 6 months is reflected in the top line we have achieved, because basically we don't have an order book as such. Basically, working with railways, yes, we have an order book of close to 100 crores, but we work with PSUs, we have an order. But when we work with auto OEMs, there is no order book as such, which basically depends on the vehicle plan they produce, and that's on monthly basis or 3 months basis.
Okay, okay. Got it. Yeah, thank you, sir. That's all from me.
Thank you. We have our next question from the line of Dhruv from Edelweiss. Please go ahead.
Hello, I'm audible?
Yes, you're audible.
Please go ahead.
Hi, good evening. Sir, could you please just give me the margin bifurcation for all your business segments, like ring rolling margins and maybe forging and press margins, if that's possible?
No, that's not possible. We don't work on individual plants. We cannot give you margins.
Okay. Also, I just wanted to ask you, currently we are at 65% capacity utilization for your press business, and we are adding 56,000 tons of capacity there. But why are we not looking at capacity expansion in ring rolling and forging segments where we are at 100 plus utilization?
Basically, like I said, that it is new capacity with new technology and new components. We add capacities basically in need based with the discussions with the customer. So we don't feel the need of right now adding any capacities in ring rolling or other places as far as customer indication in terms of future demand.
Okay. Okay. Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. To ask a question, please press star and 1 on your phone. We have a question from the line of Shaukat Ali from Monarch Networth Capital Limited. Please go ahead.
Thank you for the opportunity. Sir, a small question from my side. How the effective tax rate is going to fare for the entire year, FY23? Am I audible?
Can you repeat your question?
How effective tax rate will fare from here? Effective tax rate.
Effective tax rate, Lalit.
Effective tax rate, oh sorry.
Yeah.
Effective tax rate is in the range of around, I think we will move to around 20, in the range of 22 to 24% for full year.
Okay, sure. Thank you. Thank you from my side.
Thank you. A reminder to participants to press star and 1 to ask a question. Participants are requested to press star and 1 to ask a question. As there are no further questions, I would now like to hand the conference over to the management team for closing comments. Over to you, sir.
Thank you. We take this opportunity to thank everyone who has joined our call. We hope we have been able to answer all the queries that have been addressed to our man. For further information, you can get in touch with us, our strategic growth advisor, or investment resource advisors. Thank you very much, and have a good, pleasant evening. Thank you.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now